Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang. Today, we teach you about HoldCos. I welcome back friend and part two guest, Peter Kang of Barrel Holdings, and we're going to talk about how entrepreneurs structure and build HoldCos that last. So good that he wrote the book on it. We're also going to talk about his acquisition of AO2, which you'll have a lot of lessons learned from that deal, and the deal he's working on now where he's bringing on outside capital, other people's money, OPM. You're going to learn a lot. It's very detailed. You do not want to miss a minute. Let's dive in. Peter, welcome back.
All right. Thanks for having me, Peter.
For those who listened to your first episode, we don't need a lot of context to Barrel and what you've been building, but you've been doing things since you were on the podcast. Where we left off, you had closed an acquisition and you were integrating, but you still had this back office and this holding company that was growing, and you've winked, squinted. You said M&A is coming. It's on the roadmap. And then you announce a deal not too long after. I would love for you to give an update to the audience of the holding company, where it sits today, and then AO2. Talk us through that opportunity and run us through the sequence of events that got it into Barrel.
Yeah, definitely. Yeah, and I just want to clarify for folks in case they, Google Barrel, and then there's also Barrel Holdings. So we have an agency called Barrel within Barrel Holdings. Barrel Holdings is the HoldCo. So when we last spoke, I think we had talked about, what deal that we did, Catalog, which was, a product design agency, that was a bit of a distress situation, and we brought it in, and, we thought we could, get our hands on it and then turn it around. Didn't quite work out that way, but, we learned a lot from that acquisition deal, and it gave us the confidence to go after something a bit meatier, in the next deal. So, I can just kind of walk you through what happened last year, because we did, and I think it's funny because I remember distinctly you gave me some feedback about you have a lot of optionality, and you didn't mean it in a good way. It was just kind of like, hey, I took it as, I need to focus. I think we need to focus more and just be more strategic in how we do things. And so part of it was we had this dual track of incubating our own agencies. So we wanted to launch agencies and then do M&A as well at the same time. So we had this pipeline of 3-4 agency concepts that we were launching, and then in that we would seed it with some capital, bring in an operator to kind of spearhead it, and then build it from the ground up. And at the same time, we were doing kind of the M&A playbook of sourcing deals and talking to agency founders and trying to buy those agencies. And so it's a lot that we were juggling, and not as with most things, not doing it well, just kind of spread thin. And what we realized, we had a few subpar with some of our incubated kind of smaller, the new agencies that we were trying to start up. And we just kind of, thought to ourselves, hey, we're spending the same time on these agencies as we are with some of our more scaled up agencies. And, it just the math didn't make sense, because we're like, hey, we can't move the needle enough with these smaller ones. And, if we can bring in an agency that's, doing a few million in revenue, and EBITDA is more robust, it just dwarfs, some of these agencies that are barely, for some, were pre-revenue, right? And so we kind of had to go back to the drawing board and re-clarify our focus. And so that's where we decided ultimately to first, either shut down or exit these subscale agencies. And so, that was tough because we really liked the co-founders that we were working with, the leaders that we had brought in, but we just had to have a hard convo. So we gave them the option, hey, we'll either shut it down or we can kind of exit this business to you, and you guys can take over as the owners, and for a nominal amount. And so that we ended up doing that for Catalog. So we had brought in a CEO, kind of gave him the choice of either shutting it down or allowing us to exit, and he chose to take the business, and so we exited Catalog. And then with we had a brand design agency called Bolster that we had launched. As much as I love that business and the work that they did, had a tough convo and was like, hey, we'll either shut it down or you guys could take it. And so the two operators, they took the business. So, they're still going on today, but outside of Barrel Holdings. Yeah. So that's where, and so that kind of led us the path of all right, we shed some of the stuff. We had another business that was a pseudo deal called Super Friendly, where we had bought kind of the trademarks and, the kind of client case studies and kind of the network, brought in a CEO, and we had to try to jumpstart that as well. That too just wasn't clicking in the first 6 months. So we decided to shut that one down. So 3 agencies kind of sucked up a lot of my time in the first half of the year.
Yep.
But we just realized, this wasn't the way to do it. We need to focus on M&A.
It's the old service business, right? The low paying client demands the same amount of time and attention as
Yep.
the high paying client.
Yeah.
In portfolios and holdcos, the Pareto principle holds true. 80-20 is very consistent across a portfolio. And then you have what's called the power law distributions, which is the Matthew effect, which is the thing that's largest in the portfolio gets a disproportionate amount of the attention and capital. And then you have these, I don't want to say underperforming because it's not always the case. They're just the smallest contributions in a portfolio who don't get the same level of attention. The same thing happens in e-com and product businesses, retail, in regards to SKUs that sell in greater volume than the rest. And so it's just a natural thing as you're growing, which is great. Yeah. But then you did the thing that I wanted you to do, which is go buy people, Peter, and more substance, because they just contribute so much more. So
Yeah.
Did you have your antenna? I know you post, do you have your antennas up and you're paying attention, but was this proactive outreach? How did this business opportunity land at your desk?
Which is great. Yeah. So, I've been pretty active on LinkedIn, and we do get a fair amount of inbound, and we had been working with like a buy side advisor to do the outreach stuff. And, seeing a lot of deals that way. And of course, across all the different broker listing sites and stuff. But of all the places, like this is on a whim, like my co-founder Sewug went to like a private equity kind of e-com conference in New York City. And it was just that one of the kind of like breakout sessions or whatever, he met, someone from an Amazon agency. And, that happened to be AO2. And so, they got to talking, and, the founder, Nate, was like, hey, looking to, exit the business. And, that's how the conversation started. So I was like, wow, all the effort. And then of course the deal comes from something totally random, but I think that's how it goes. And, we try to like appreciate that and just be in different places, because you never know where the next deal could come from.
Yeah, it's an important lesson, right? You should do all the things.
Yep.
Because you don't know where the good deal is going to come from. I would presume you started becoming better at the pattern recognition because you were looking at so many businesses.
Yep.
You also had a finer tuned process. So by the time AO2, a real opportunity that you were excited about came in, you were prepared.
Yeah, definitely. Yeah. AO2 just, as a business, so we started talking to them in, early 2025. So this is like February, let's say March. And the LOI was signed like at the top of April. But, this is an Amazon agency. And, what happened in April last year? Obviously the tariff situation came down. And so that was a rocky start to kind of the due diligence process, because it was kind of like, wow, like, clients churning or pausing, right off the bat. So, we really had to kind of like, I think we were a little bit on edge, and the seller was, very much on a timeline for personal reasons, wanting to, kind of get the deal done very quickly. So, we all kind of felt that pressure, but at the same time, we're like, wow, the news isn't great, and, the numbers aren't so great in in April. But like, I think we all kept our cool. And, I think we had a good rapport with the seller. And, just throughout the process, no one kind of lost it. So like we were able to work through that, and the numbers did pick up. So thankfully it did stabilize. But the key thing, one thing that we really learned from this process was just with our HoldCo model, our vision is, we bring in these agencies that could stand alone. We don't need to necessarily like merge them into an agency, like especially if they're of a certain size and revenue. We want them to kind of retain their brand, retain their culture, and just kind of operate. But a lot of these deals, like, the founder wants out. We really need to figure out who's going to run the agency post close. And our preference is to promote from within. And so that becomes that's become another criteria in what we look for, is like, hey, is there a suitable number two that can step up, who can step up and take the place of, the founder, and really, lead the team. And they might still have some gaps that we might need to fill through some hiring, but we'd rather the new kind of CEO be from within. Just sends a message to the team, and I think there's a continuing aspect. So we wanted to see if AO2 had that, and luckily for us, like we found that there was a president in place who just like had the respect of the team, like super capable. And, just, I knew within the first few conversations, like, wow, like this is, going to be a really, an added asset just for the HoldCo in general to bring someone of this caliber into our orbit. But also, yeah, like this company, I think will be in good hands and stable hands with someone like this at the helm. So that was actually, you know, even with the finances a little bit wobbly from the tariff stuff, like we felt really good that having someone like this in charge would be a benefit to the deal.
Right? Yeah, timing's useful. So if you would have advanced the deal prior to the tariffs, you would have had an underperformance right after close.
Right, right.
You got to pressure test some of the business and the risks in the business by doing due diligence during a time of turbulence, which is actually very beneficial because it
Yep.
helps you create, hopefully, a structure that I don't want to say mitigates it, but takes it into account as you're planning the company's operations under new management. And then he had been working to sell the business for personal reasons for a while. So he was really feeling the pressures of making a move and finding the right buyer for this. So walk us through LOI. So LOI was signed when?
Like beginning of April.
Beginning of April. You kicked off due diligence. He had been fairly prepared because he had been, trying to have discussions around his next transition. How quickly did he get you what you needed for due diligence?
Yeah, it was pretty quick. I'd say like, yeah, most of the materials were pretty quick. I mean, there was some financial stuff that just needed to be cleaned up and updated. And, we had a lot of back and forth around, some of the ad backs and stuff that, we didn't quite agree with. And so just aligning on that took a bit of time. But yeah, overall, like I'd say, yeah, I've seen worse. So this wasn't bad.
Yeah. Is there anything that you feel you do unique? Because you've seen a lot of due diligence. You've seen my detailed process. You also have your own way of assessing cultures because you're looking for stewards of the business to contribute, not be assimilated. What's something that you feel is unique to your due diligence process that makes you feel even more confident to move forward with close?
Yeah. When I think about, yeah, just like our process, and part of it is, that's the thing with this one. Really, I think we spent a lot of time kind of really understanding the client roster and just like really trying to dig deep into like, hey, like what is the state of each client relationship, and just kind of like going line by line with that and understanding and just like, first of all, look at the historicals of like, okay, like how long has this been client been with the agency, like what kind of services are they buying, what's have they paused in the past, like how have they been with payments, all that stuff. So like we kind of did a lot of that, and then like every month during that due diligence process we just revisit to see what the changes are in the delta. And like I think that was really helpful because by the end we were like, okay, cool, like we know we color coded like, hey, these are like the kind of solid bedrock clients that I think we're gonna be retained post close. But here's some ones that we're feel good about but not 100%, and then here's ones that are definitely at risk, and like what can be done to better retain these folks. So yeah, I think those things, yeah, like we'll continue to do that. But like I think that was really helpful for us in terms of due diligence.
100%. You understand agency businesses. You understand client expectations and relationships. You know that because you're from the sector.
Yep.
And so you're able to scrutinize and evaluate these businesses with a little bit more commercial capability than just a traditional Q of E, which is clients paid, here's their invoice, here's the bank account, and they've been a client for this long. I'm curious with that, did you have anything in the deal structure that needed to be adjusted based on that?
No, not really. I mean, like we've been, we were pretty good about just like not trying to retrade, or as long as like things were like materially off, like as long as we didn't find anything egregious. Yeah, so we kind of gave us a threshold of like, hey, like if it's off like 5-10%, that's fine. Like within a reason of like you can make it up, or just like, yeah. So we didn't have to do any
Didn't
kind
have
of
to adjust it. Yeah, when you start examining the clients and you're getting into the quality of the revenue, reoccurring projects, lifetime value, retention, periodization of client engagement or activation, it often is something you discover after signing an LOI, after you've set expectations around a deal structure or purchase price. And it can lead to, I'm very careful calling it retrading, although I've never retraded an LOI. It leads to people saying, I'm going to give you the number you want, subject to due diligence. And then because they weren't as familiar with the sector, They learned things that they didn't know before, and then they feel uncomfortable with the new levels of risk, and they try to adjust or recalibrate the deal to fit that risk profile. And one of the benefits I believe in your holding company, and also as you guys as founders and capital allocators, you know the industry so well that you are investing in. You know the founders really well. You have the pattern recognition, and you're able to then confidently move forward with things that you've already committed to, which I really appreciate. You're such a great example of that in the market.
No, that's our whole thesis is, how do you take, 2 decades of making every mistake in the book and distill that into something hopefully more valuable?
How did you negotiate? Let's talk about to some degree the negotiation process. So this was a founder who was leaving. You're buying a business that you know is being added to the portfolio. How did you approach risk, liabilities, uncertainty? What did you make him rep? What are some of the things that were important to you? What were some of the things that maybe he negotiated against?
Yeah, I mean, part of it, this was like a heavy cash at close situation. So a lot of that deal was that, we had a seller note that was kind of tied to some revenue, baseline number. So it's kind of like, hey, it protected us from, a precipitous revenue decline within the first couple of years. So, there was that component to it. And then, one thing, so, I think this is kind of the piece that we kind of not do in the future, but we do have as a sweetener at the end, we did kind of add like a little, a profit share component for the seller for the long term, that, over a few years, like on top of the seller note, that like we thought would motivate, the seller to just kind of, still, you know, have a relationship with us. And yeah, that component, just in hindsight, I'm like, I didn't realize how quickly, the seller would kind of transition out of the business. So like, I think, in hindsight, like that's probably not something we'd do again.
You didn't need the sprinkles, the cherry on top, and the syrup. You're
Yeah,
fine with everything.
yeah. And that's
Yeah.
probably like, yeah, just at the finish line, I think we kind of blinked first on that front. But yeah, like just in hindsight, probably wasn't necessary. So yeah, that's something we, yeah, avoid in the future.
Yeah, yeah. The deal structure or the deal stack can get a little bit convoluted with incentive, right? And your key driver there is how can we incentivize the founder or the operators in the business to make this thing continue to grow based on the expectations that we're setting in this deal.
Yeah.
Most of the time, our recommendation is do that in retention bonuses. And was there any, without getting to the specifics of the deal, because it's still rather fresh, but was there anything tied to the key people who were sticking around, or was this a true founder transaction?
Yeah, no, true founder transaction. So yeah, there's no kind of considerations on that front.
Yeah. When I did a deal to buy 3 million of EBITDA, the founder was the chairman of the board. He had a CEO in place. The CEO had small profit share, a profits interest position, but not enough for it to be economically beneficial for the transaction. And I negotiated a third of the purchase price be allocated to retention bonuses. Essentially, I negotiate on behalf of the employees staying with me a piece of the action that he didn't want to give them. He didn't give it to them ahead of the transaction. He wasn't giving it to them as a thank you for the transaction. And so I forced it on the deal, and made sure that the people who are going to drive growth for me, rather than profits interest to him, retention bonus for the team. And it worked extremely well.
Yeah.
And that's a common strategy for many of you who are listening. I do want to touch on something. Hey, reflecting on your journey to where you are today, you're obsessed with holdcos, so much so you wrote a book on it. Shameless plug. I originally thought this was his book, but this is his future book. So go to peterkang.com and you can read a version of this book. But you're obsessed with holdcos. You're obsessed with Berkshire, Warren Buffett, and everything that went into building that empire and that massive return that was generated for those people who gave their money to Warren. How are you thinking about the HoldCo today? So maybe give some context to the reader, because now you wrote the book on HoldCo. Give some context to how you operate Barrel Holdings, how that differs from how many people think HoldCos work, and then what's your strategy now that you have M&A under you moving forward?
Yeah. So it's funny because like the only, HoldCo that I really knew at the start was, Berkshire. So I was like, oh, that's like the, the HoldCo to kind of aspire to. But just along, just with the experience of, just putting together barrel holdings and doing some research as well, and like, hey, what else is out there? I just learned a lot about different flavors of holdcos. And in my book, I talk about kind of two different flavors. One is kind of this pure capital allocator model, which where Berkshire falls more into, where it's not less about, they'll look for good businesses, they'll buy the good businesses, and then these businesses are throwing off cash, and they'll take that cash flow and use that to buy other businesses. And it's a very straightforward model. A lot of their magic comes in, making sure they buy good businesses. So the other type of holdcos is the operational holdco, where this is where if you have a POV on how certain businesses should operate, and how maybe you have a certain kind of business system playbook, you have very kind of strict cost control measures, or just kind of margin targets that you really want your business to hit. You have this institutionalized approach, and then as you acquire um, uh, businesses, or you're bringing that to bear. You bring them in. You might still keep their brand, and you're not necessarily taking over and taking away their autonomy, but you're giving them the frameworks. You're kind of guiding them towards becoming more operationally, coherent with your holdco's vision. And just going through that, there are companies like Danaher is a good example. They do like life sciences, historically some manufacturing companies. Like they've built like this the Danaher business system, which is really powerful way to make their acquisitions even better. They improve margins, they help with growth. They run like a very strict Kaizen process to do continuous improvement. So, just learning from that, we're like, like where do we fall within those buckets? And more and more, I realized, okay, Barrel Holdings is more on that operational, holdco side, because we do have some strong POV on how agencies could be run. There's certain investments I think agencies should always be making in their organic growth. We think they have opportunities to grow inorganically as well. So being open minded about that, but also like just some some POVs around like culture, client service, as well as like processes, documentation, things like that. So we thought, hey, let's lean into that, and then understand that that's where we bring a lot of the value. And so that's where in writing this book, I just kind of got a better sense of, okay, this is what I think we're going to be about as a holding company.
You also have a holdco that has two founders. You've been allocating your own capital, the balance sheet of your businesses and the personal balance sheets of the founders. And yet the examples in your book, Peter, other than the family office ones, even the family office ones in many respects, start becoming capital allocators of other people's money. So let's talk about that, because you've been curious and investing and thinking about the next phase of growth, of extending what you can do with the holding company. Where are you sitting on the risk tolerance of OPPP, other people's money?
Yeah. So it's funny, like my co-founder Sewuk and I, we talk about, just resisting getting the obligation of managing other people's money for a while. But, as we were looking at a lot of deals, and, we were looking, obviously, we have, we're the cash flows are kind of, helping to build up, our kind of, the dollars we want to deploy. But some of these deals, we were like, oh, they're a little bit bigger. And, so we're leveraging SBA 7A loan for the debt stack in the capital stack. But we're like, hey, at some point that's gonna run out, or we're gonna have to. Obviously, there's conventional loans as well, but like it'd be good to just have some more equity that we could deploy into these deals, because like you just don't want to be levered, 90-10 all the time. so so we were like, hey, we probably need to explore raising dollars. And so, we made a decision of like, look, whatever the next deal is, let's go, let's make sure to at least start building a track record. And, even if it's a smaller amount to start, let's raise some dollars, and then, get some points on the board, so that as we need on a deal by deal basis, we have the ability to raise more. And before that, and we had even thought about, oh, like, should we issue shares at the holdco level and raise, kind of at the holdco level. So, we thought about that, but, just, I think it was a little premature, because like, we're like, look, I think we're maybe a couple of years from getting to an EBITDA that gives us a kind of aggregate valuation where we can just, issue shares more comfortably. But at the moment, like I think on a deal by deal basis, we could, offer some really, compelling terms for investors. Let's see how we can push this. And, taking cues a lot from obviously the search the search community, right? ETA, like those kinds of deal structures. We thought we could make this work.
Yeah. If you have a good deal on the hook, you can find the money for it.
Yep.
A lot of people go, hey, I want to do M&A or I want to buy a business, but I don't have access to capital. And my advice is always more straightforward than most expect, which is if you have a deal that has free cash flow, it's a solid business, and you're a good operator for that business, you can find the equity, you can find the capital to get that deal done. Trying to find it ahead of time, people won't take you very seriously. So
Yeah.
because you are thinking about returns for your investors, what did you have to learn? Who do you have to hire, whether it be legal, to start approaching this the right way? Because now you're trading in securities, you're leveling up. And
Yep.
although it's a small relative to a barrel holding size, relative to the future potential if you bring on investors at the barrel holdings level, you still had a knowledge gap from kind of your maturation process
Yeah.
through in your development process. So what did you learn that's new? What are some of the things that if someone's listening to this wants to follow in your path, you would recommend?
Yeah, one of the things that kind of gave us a bit more confidence about this path, it came about is actually from your recommendation way back when we first met. Like, you told me to listen to Ryan Sullivan's podcast, the North Park Group, right? Because he's been building a HoldCo of manufacturing companies. And it's funny because since then, like I had listened to a couple other podcasts with Ryan on it, and he talked more about the fundraising process while pairing that with a SBA 70 loan and having a holdco of now like what 6-7 companies in the portfolio. So I reached out to Ryan too, and we had a good convo, and he was kind enough to share more about the deal structures and how he's raising dollars, and it was really compelling in the sense of like and just being able to look at one of their sims as well, and just kind of like understanding how they position these
Yep.
things and structure it. Like it was a great education, and that was kind of the start. And then beyond that, I had some other friends kind of in the either private equity or like the roll up space of different home services and stuff, and so they share some docs as well, and I was able to just get feedback from some finance friends and others who had raised money, so that was really helpful. And then of course, like ChatGPT is a good friend. They don't always tell the truth, but like they give you at least a starting point. So there's a lot of back and forth there. And then once things got serious, yeah, definitely getting some legal counsel on that front. And then obviously there's the certain docs and disclaimers and stuff that we have to have buttoned up. But yeah, it's been quite a learning curve, and like I just going from where I was, let's say at the end of Q3, early Q4 and last year to now, it's like it's been a really uh yeah, like a speed run of like learning how to raise dollars. And
Yep.
yeah, just like with and it's been great, like just putting out that first sim to kind of go around and see if there's
Yep.
interest. It was a bit nerve wracking, but like feedback has been great, and just yeah, it just gives me a lot of confidence that like, hey, there's something here. If if you craft it right, you have the right kind of deal in place, like you can, yeah, like just like you said, you can raise money. People are willing to invest in good deals.
Yeah. I still think you're playing small. What's really interesting about incremental professional development, especially as you're extending the risk profile of yourself, your investment thesis, your partnership, the same thing you highlighted as your migration from spin out small deal to bigger deal requires the same amount of energy and effort. Same thing goes with fundraising. Small checks take the same amount of time, and they're almost even more annoying as investors than big checks. And so you're definitely cutting your teeth in ways that allow you to build a reputation of returns. It's not something that is going to take down the house if it doesn't go according to plan. And then I'm just so excited about the next phase. Like you're gonna have to come on and do episode 3, episode 4, and episode 5 because you keep doing these things with such like sequential steps, Peter, that I don't want to get. Like I just got to bring you back every time. Well, let's talk about returns. So have you thought about returns for the HoldCo the same in this new investor-led acquisition opportunity, or did you have to alter the way you thought about HoldCo returns and
Yeah.
dividends to do this?
Yeah, we had to, because I think the original model was like, hey, every acquisition is going to be immediately like cash flow accretive, and we're gonna be able to grow our cash flow right off the bat. Just with how we're structuring it, there's like a preference stack there that we're gonna have to pay back the investors first for
Yeah,
the first few
you have a
years.
preferred return,
Yep.
right? And then I believe you have a catch up to get you there, but you've thought through it, which kind of makes this first deal a true experiment on the HoldCo because it's you don't get that accretive cash flow day one.
Yeah. And there's a couple things to like help offset. There's a management fee, which just nominally kind of, at least like it's not a net negative for us. And then there's definitely you're paying down debt along the way as well. So we're increasing our equity on that front. So those things, but like what we're learning there is like, okay, and part of why we're okay with that is like the other agencies that we own outright just are performing well, and they have been growing. The EBIT has been growing on that front. So like cash flow has been growing organically there. So like we were like, okay, we can be patient, it'll take maybe 2-3 years to kind of get to that catch up phase. And I think that's when cash flow can pick up again. So that was where, we thought, hey, like we don't need to rush in. And, at the end of the day, like this will still be a super valuable asset. Yeah, that's where we justified it.
Right. You're bringing in investors, but you're also still leveraging the SBA.
Yep. Correct.
And so it's still, that has its requirements, which should make investors even more confident in you all. Given the amortization schedule, given the length of time this payback period is, given the fact that you have investors and you're buying and investing in agencies, how did you communicate the disclosure or the disclaimer and the risks of AI on the investment thesis? Because that's an important thing. And a lot of people have been thinking, okay, well, I want to buy an agency. I want to buy a professional service business, but AI is there, and no one can tell me what AI businesses are going to, the disruption is going to be, what's the impact going to be 2, 3, 5 years from now. But your payback period is outside of that.
Yeah.
Your patience is much longer. So how do you go about thinking about it for the listener who's considering buying something and the payback period of the loan is greater than maybe their vision of the industry?
Yeah. I mean, I think this is like such a big topic.
It's not an easy question.
Yeah, and no, honestly, like everyone I talk to, there's there's a few different camps around it. I think where and we fall in at the Barrel Holdings level is like, look, if at the end of the day, you still there's still a human to human element of any kind of service offering, and those that can leverage AI as effectively as possible, and while running lean. And so I think part of why our thesis is like this like it looks like we're playing small ball, but like I think there's an advantage to this in the sense that like, look, you have lower headcount. These are like sub 30, sub 20 person firms, but they can handle in some cases hundreds of clients, leveraging AI and automation, and just great processes, while still providing the much needed human to human layer of client services. So yeah, we talk about that in our docs as well. Just like, look, we're leveraging AI as a tool, and but at the same time, like we're running super lean. There's room to kind of continue to invest in the processes. So yeah, we're optimistic and bullish about what AI will enable. Just it's actually going to introduce more complexity, in our minds, and it's going to need more people to help navigate some of this stuff. So it's very different than some folks who think they're going to be kind of become obsolete overnight. But part of that is we do expect culturally everyone to be nimble. Everyone has to be thinking ahead of like, hey, what's going to create value for the clients that they serve, and how do you leverage tech to do that?
Right. Ryan doesn't assume an arbitrage on his deals, and neither did you. So you didn't have a divestiture in your returns because you look at holding companies a little bit differently.
Yeah.
most private equity, especially ones in the agency space, with like Mountain Gate as an example, when they grew Tenuity, they bought into Tenuity at what was their EBITDA? Probably 5 million of EBITDA, and then through the ownership, they grew it to 32 million of EBITDA, and then they sold it to New Mountain Capital, and then New Mountain Capital took from 30 to 100 in EBITDA, and you just have this margin expansion and EBITDA expansion that then helps accelerate the returns. And that's the private equity playbook. Your playbook's different. Maybe explain why you've not factored that into your approach, because you're more of the longer term vision, the founder in the company underneath your holding co for the duration.
Yeah. I mean, that's one of the advantages of like not being, a fund. There's no kind of timeline to, kind of book the returns on our assets. And so just, true to kind of some of the HoldCo inspirations that I've researched, we Sewak and I set out to create this. We wanted to create a vehicle for the next, 20, 30 years. And, we thought, hey, we're going to make money, but, it just might not be at the timeline of, it's probably not the next 5 years, but definitely, 10 plus, it's going to start to compound and we'll recognize the benefits. So, that allows us to, be more deliberate and paced about certain things because I think the pressures that you can put on an agency can lead to some poor decisions in the short term that can impact on the long term. And so we want to kind of take that off the table and go, hey, look, like just grow responsibly and like, just first and foremost, just continue to just survive as a business because it is a volatile agencies. It is a volatile business, and too many times, I've lived through it, and I've also seen it in others of like just you can have a great year one year, you could post great numbers, and then just kind of fall on your face the next year. And so being able to survive through that is super important. And so structurally, we just go look like we're not here to rush the growth, and we don't kind of see we don't model out like multiple expansion by any means. But
Yep.
what we do want is, just can you get to 5-10%, steady growth and kind of, hold your margins fairly steady. If you can do that, that's going to be a great outcome, over, 8-10 years.
Given the fact that you're sharing in real time, if someone wants to learn from you, besides going out and buying the HoldCo guide, where do you typically recommend they go? Because you post online, you have a blog, you have a newsletter. What are some ways that people can get you as a mentor without taking up your calendar?
Yeah. I'd say like just on peterkang.com. Yeah. Signing up for my newsletter is the best because I do kind of, whenever I post a monthly blog post on, I call it the agency journey and, just reflecting on what's happened the past month. But then I also list like my LinkedIn posts from that week there as well. So it's just a good place to keep tabs on my stuff I'm sharing. And then we have another site called Agency Habits, which is, more, like the structure, like we have a podcast there where we're talking about, my co-founder and I, we just talk weekly about just very specific agency topics. Might be partnerships one week. I think last week we talked about like employee compensation within agencies, things like that. We just nerd out on agency topics and just kind of share stuff that we've learned and observe across our agencies as well. So I think those are areas that, people can get a lot of info and, kind of window into how we think about things.
Peter, I appreciate you creating those windows of opportunity for the ecosystem and for the founders who are trying to do the things that you're doing. And those of us who are actively in the same ecosystem as you, just appreciate you for your transparency, your authenticity, and really the grounded approach you've brought to the HoldCo and the expanding business and investments you've been doing. So, Peter, I appreciate this is number 2. You'll be on number 3 because you're about to close it, probably another acquisition, and then you'll have another one after that. So, my friend, thank you again for being such a great resource for everyone. And I wish you the best of luck on this oversubscribed next deal, all the success you're having. And we'll get you on here again soon.
All right. Thanks for having me, Peter.
If you like this episode, probably like one of our other episodes, click here.